Stop, don't blink, don't rewind the chart. I want you to understand something right now. What you just watched was not a normal price move. It was a structural event. Silver did not pull back. It violently traversed nearly 12% in a single session, a move that statistically ranks in the top 0.3% of all trading days in modern silver history. That does not happen in stable markets. That does not happen at tops. That happens when a pricing system is under strain. While you were watching the wick, over $6.4 billion in notional paper silver changed hands, open interest barely declined, physical premiums stayed elevated, and lease rates refused to cool. Translation? The paper market convulsed, but the physical market didn't flinch. That's the tell. This wasn't panic. It was pressure. And pressure doesn't release unless something underneath is breaking. If you think this was the bubble popping, you're already behind the move. The real question isn't did the bubble burst, it's why the system had to scream this loudly just to hold price down for a few hours. Before you even think about bubbles bursting, you need to understand what that shooting star actually represents in modern, algorithm-dominated markets. What you saw on that chart was not fear, and it wasn't a natural reversal. It was a liquidity probe. In 2025, price discovery doesn't happen gradually, it happens in violent bursts, when algorithms test the structural integrity of the market. That vertical wick wasn't random. It was a deliberate stress test to see how much paper supply could be shaken loose at elevated levels. Here's the part most people miss. Shooting star candles used to signal tops back when humans controlled markets. Today, they often signal where liquidity is hiding. When silver flashed above $80 and snapped back, it exposed exactly where stop clusters, margin thresholds, and dealer hedges were stacked. CME positioning data already showed speculative long exposure at multi-year highs going into that session, while commercial shorts were heavily layered between $78 and $84. That wick was the collision point. The market didn't reject higher prices, it mapped the battlefield. And notice something subtle. Despite one of the largest intraday ranges in decades, open interest barely collapsed. That tells you positions didn't vanish, they rotated. Weak hands were replaced, not removed. Historically, true bubble tops show shrinking volume after the wick forms. This one formed on expanding volume, which is the opposite condition. Even more important, volatility-adjusted value-at-risk models forced CTAS to de-risk temporarily, meaning forced selling occurred without a macro catalyst. No rate hike, no dollar spike, no demand destruction. That's critical. When price collapses without a macro driver, it almost always rebounds once forced selling ends. This is exactly how silver behaved in early 2011, late 2020, and again in mid-2023, sharp upside probe, violent rejection, then a higher base. If this were a real bubble burst, premiums would have imploded, lease rates would have eased, and ETF outflows would have spiked. None of that happened. Instead, lease rates stayed elevated, physical demand remained tight, and vault drawdowns continued. That's not a bursting bubble. That's a market-flushing leverage at the edge of discovery. What makes this shooting star especially dangerous for emotional traders is that it weaponizes time, not price. Everyone focuses on the dollar move, but the real damage happens psychologically. The market sprinted upward faster than people could emotionally process, then reversed just fast enough to make late buyers question reality. That's intentional. In thin liquidity environments, and December is one of the thinnest of the entire year, price moves exaggerate sentiment shifts. Algorithms exploit this by compressing weeks of emotional movement into hours. And here's the part nobody on financial TV will tell you. Volatility spikes like this actually lower institutional entry prices. Pension funds and sovereign allocators don't chase vertical candles. They wait for volatility-adjusted retracements. A shooting star creates exactly that condition. Internal risk models mark the asset as volatile but trending, which opens the door for staggered accumulation rather than momentum rejection. That's why the market didn't collapse after the wick, it stabilized. Look at realized volatility versus implied volatility. Implied exploded, realized stabilized. That divergence tells you fear is higher than actual damage. Meanwhile, the gold-silver ratio barely reacted proportionally, meaning silver's move was self-contained. not macro-driven. In true bubble collapses, think tech in 2000 or crypto in 2022, correlated assets unravel together. That didn't happen here. Gold stayed anchored, the dollar didn't surge, and bond yields barely flinched. That means capital wasn't fleeing the system, it was reallocating within it. And here's the uncomfortable truth. Most people who panic sold into that wick didn't lose because silver fell, they lost because they were positioned for smooth price action in a market that has become structurally violent. Modern commodity markets are designed to punish linear expectations. If you expected a straight line to $100, the market just taught you a lesson. But lessons aren't endings, they're tuition payments. And historically, the most aggressive upside phases in silver begin after volatility events that convince the majority they were wrong to believe. Let's talk about the physical reality behind the paper chaos, because this is where the bubble narrative completely collapses. If this were a genuine top, physical behavior would have cracked first. It didn't. Dealers didn't slash prices. Refineries didn't report excess supply. Industrial offtake didn't pause. In fact, according to updated fabrication forecasts, industrial silver demand is still projected to exceed 1.2 billion ounces annually, the highest level ever recorded, while mine supply remains constrained by declining ore grades and underinvestment. That mismatch doesn't disappear because of a candle. Here's something most investors don't know. During violent paper sell-offs, authorized participants often delay ETF redemptions because sourcing replacement metal becomes harder, not easier. That creates temporary paper weakness, while physical tightness intensifies. It's backwards from what retail expects. And look at premiums. In prior true collapses, premiums compress violently as sellers race to unload metal. This time, premiums stayed sticky or widened. That tells you no one with metal was desperate. Only paper holders were. Even more revealing is what didn't happen: miners didn't hedge aggressively into the spike. Forward sales remained muted, suggesting producers don't believe current prices represent fair value. When miners refuse to lock in profits during supposed bubble highs, it's because they expect higher realized prices ahead. Combine that with elevated lease rates, declining COMEX-registered stocks, and ongoing central bank gold accumulation, which historically drags silver along with a lag, and the idea of a burst bubble starts to look ridiculous. Bubbles end when supply overwhelms demand. This market can't even meet baseline demand without drawing down inventories. A shooting star doesn't change that math. It just reveals how fragile the paper scaffolding has become. And this is where the shooting star stops being a warning sign and starts looking like a stress fracture in the control mechanism itself. What most people don't understand is that markets don't break when price goes up too fast. They break when the systems designed to contain price start showing strain. That shooting star wasn't just a failed breakout attempt. It was evidence that suppression now requires exponentially more force than it did even a year ago. Think about the mechanics. To push silver down nearly $9 in a single session at these price levels required an enormous volume of paper contracts dumped into an already thin holiday market. That is not cheap. Margin requirements are higher, collateral costs are higher, and regulatory scrutiny is tighter than it was during prior cycles. Every violent smash increases the cost of the next one. This is basic market physics. The higher the base price, the more energy required to move it the same distance. In other words, the wick you saw is not proof of strength from sellers, it's proof of desperation. And here's the detail most commentators ignore. After the wick formed, price didn't cascade lower. It stabilized quickly. That tells you forced selling ended fast, which means leverage was cleared efficiently. In past true tops, liquidation unfolds over days or weeks as confidence erodes. This happened in hours. That's not distribution, that's cleansing. Even more telling is what happened underneath the surface. Short-term volatility spiked, but longer-term implied volatility barely moved. That means the market expects turbulence now, not collapse later. Professionals price risk forward, not backward. If institutions believed this was the top, longer-dated options would have exploded in cost. They didn't. That's a massive tell. Add to that the fact that cross-asset correlations barely budged, equities didn't crater, bonds didn't surge, the dollar didn't spike, and it becomes clear this was not a macro rejection of silver. It was an internal plumbing event, a pressure release. And pressure releases don't end trends. They allow them to continue without blowing up entirely. This is exactly how markets transition from speculative to strategic ownership. The tourists get shaken out. The allocators step in quietly. Volatility scares away people looking for certainty and attracts people looking for asymmetry. That's why calling this a burst bubble misses the point entirely. Bubbles end in silence, not chaos. They end when nobody cares anymore. Right now, everyone cares. Everyone's watching. Everyone's emotional. That's not an ending, that's a midpoint. And remember, this is only number 7. The forces driving this market haven't even fully entered yet. The story isn't over. It's just getting heavier. What the shooting star really exposed is the quiet collision between legacy pricing models and a market that has fundamentally outgrown them. For decades, silver pricing relied on assumptions that no longer hold: abundant above-ground supply, predictable industrial demand, and paper markets that could always smooth volatility. That world is gone. What happened during that session was the moment those outdated models failed in real time. When price surged and snapped back, it wasn't because demand vanished, it was because the pricing mechanism couldn't process demand fast enough. Algorithms are still calibrated to a silver market that trades like a sleepy commodity, not a strategic material embedded in energy infrastructure, defense systems, and monetary hedging. Here's the underappreciated data point. Industrial demand elasticity for silver has collapsed. Solar manufacturers, EV producers, and electronics firms cannot easily substitute away from silver without massive redesign costs. That means price spikes no longer reduce demand the way textbooks predict. When demand becomes inelastic, volatility increases because price must do more work to balance the market. The shooting star candle is the visual artifact of that imbalance. And look at the timing it occurred during one of the lowest liquidity windows of the year, when marginal flows have outsized impact. That's when weak frameworks break. If the market were truly topping, you would see demand destruction signals, delayed procurement, inventory accumulation, widening contango. Instead, we're seeing the opposite: backwardation pressure, tight lease markets, and accelerated offtake whenever price dips. The candle didn't signal rejection of higher prices, it signaled rejection of old assumptions. And once assumptions break, repricing follows not smoothly, but violently. This is why attempts to cap price now require shock and awe tactics instead of gentle nudges. Each intervention leaves scars on the chart because the system is no longer flexible. The shooting star is one such scar. It tells you the market is transitioning from a controlled environment to a contested one. And contested markets don't top quietly, they fight their way higher in bursts, pauses, and shocks. Another reason this candle matters far more than people realize is that it fundamentally alters forward behavior, not just backward interpretation. Markets are reflexive systems. What happened doesn't just describe the past, it reshapes future actions. After a move like this, every participant recalibrates. Traders reduce leverage, dealers widen spreads, funds stagger entries. And here's the key: those changes reduce downside velocity going forward. Shooting stars early in major trends often function like fire drills, painful, chaotic, but ultimately strengthening the structure. The market learns where it breaks, then reinforces those points. Look at positioning going into the move versus after it. Speculative length was concentrated and fragile. Afterward, it's thinner and more resilient. That means future advances require less forced selling to interrupt them. Counterintuitively, that makes higher prices easier to sustain. Also consider signaling effects. The wick established a visible reference point. Everyone now knows where price can go. That psychological anchor matters. Humans and algorithms alike treat prior extremes as magnets. Once a market has printed a number even briefly, it becomes part of the mental map. The idea that silver can't trade above certain levels dies the moment it does. From that point on, pullbacks are framed as retracements from a known high, not failures. That shift alone changes capital flows. Add to that the calendar effect. We are heading into a period where capital resets, mandates refresh, and underallocated funds scramble to catch up. A volatile breakout followed by consolidation is exactly the pattern long-term allocators prefer. It gives them cover to enter without chasing. That's why dismissing this candle as bearish is a surface-level red. Its deeper impact is that it reorganized behavior across the entire ecosystem, and markets move on behavior more than charts. Number 3. When you pull back far enough, the shooting star stops looking like a market failure and starts looking like a systems warning that the old pricing regime is breaking under stress. This is the part almost nobody wants to confront, because it forces you to abandon decades of mental shortcuts. For most of modern financial history, silver lived in a tightly managed box. Price spikes were suppressed, volatility was muted, and the market behaved like a derivative of gold rather than a strategic asset in its own right. That framework only works when supply chains are flexible, inventories are deep, and industrial demand is optional. None of those conditions exist anymore. What that candle revealed was not exhaustion, but conflict. Two incompatible realities collided: a paper market designed for abundance and a physical market operating under scarcity. When those worlds collide, the result isn't a smooth trend. It's violent repricing attempts followed by abrupt containment. That's exactly what a shooting star represents in this context. It's not buyers failed, it's the system couldn't clear at that speed. And here's the deeper layer most people miss. Volatility is now doing the job price used to do. In constrained markets, volatility becomes the balancing mechanism. Instead of price slowly rising to ration demand, the market uses sudden spikes and drops to shake loose supply, force hedging decisions, and reset positioning. That's why these moves feel extreme. They're doing structural work. And once you see that, the idea of a burst bubble becomes almost laughable. Bubbles end when marginal demand disappears. Here, marginal demand is being delayed, not destroyed. Industrial buyers didn't walk away, they waited for the dip. Funds didn't abandon the asset, they resized and re-entered. Even retail didn't disappear. It got quieter, more cautious, more selective. That's maturation, not collapse. Look at historical analogs: oil in the early 2000s, uranium in the mid-2000s, even gold in the 1970s. Each experienced violent mid-cycle shocks that were widely interpreted as tops at the time. In hindsight, they were accelerants. They forced consolidation, attracted smarter capital, and redefined valuation frameworks. Silver is walking that same path, but faster, because the world is moving faster. Energy transitions, monetary fragmentation, and geopolitical risk are compressing timelines. What used to take years now happens in quarters. The shooting star is a timestamp on that compression. It marks the moment when silver stopped behaving like a sleepy commodity and started behaving like a contested resource. That's why reactions are so emotional. People sense the shift, but don't yet understand it. And here's the final point that matters most. If this were truly the end, volatility would be declining, not expanding. Price would drift, not snap. Interest would fade, not intensify. None of that is happening. Instead, every move is louder, faster, and more crowded. That's not a market rolling over. That's a market being re-rated in real time, with resistance, fear, and disbelief fighting every inch of the way. This shooting star didn't end the story. It underlined the chapter title. And the next chapters are where the real repricing happens. The second thing you need to understand is that this shooting star permanently changed the risk profile of silver. And that matters far more than the single-day price damage. Markets don't just move on fundamentals. They move on how risk is perceived and priced. Before this event, silver was still being treated incorrectly as a semi-speculative satellite asset. Something you trade, not something you structurally allocate to. That candle shattered that illusion. When an asset can move nearly $10 in a day without a macro trigger, without a currency crisis, without a rate shock, it forces every serious institution to reclassify it. Risk committees don't ignore moves like that, they rewrite playbooks around them. And here's the twist most people miss. Reclassification doesn't mean abandonment. It means formalization. Silver is moving from optional exposure to managed risk. That brings slower entries, tighter controls, and paradoxically larger capital pools. The wild, uncontrolled leverage that fueled the vertical spike just got punished and reduced. That makes the next advance sturdier, not weaker. Also consider what just happened to volatility sellers. Funds that made money selling calls and harvesting premium just got burned. That forces them to pull back, which reduces artificial supply in the options market. When volatility sellers retreat, upside becomes less capped. This is how pressure builds quietly. Meanwhile, sovereign actors and central bank-adjacent entities don't react to daily candles, they react to regime shifts. A market that can no longer be quietly suppressed without public fireworks becomes politically and strategically sensitive. That's when off-exchange accumulation begins. That's when transparency declines, not increases. The irony is that retail sees chaos, while institutions see opportunity wrapped in cover. Everyone is focused on the wick, but the real signal is that the market survived the test. It absorbed an enormous shock and stabilized at levels that would have seemed impossible months ago. Survivability at higher altitude is what matters. That's how assets graduate. And once that graduation happens, price doesn't return to old comfort zones, it builds new ones. The fear you felt wasn't a warning to exit. It was a warning that the rules have changed. And here is the final truth most people are not emotionally prepared to accept. This shooting star didn't mark the end of excess, it marked the end of disbelief. Disbelief is the fuel that powers the early and middle stages of every major bull market. As long as people think moves are fake, manipulated, temporary, or unsustainable, capital stays hesitant. The moment disbelief cracks not optimism, not euphoria, but disbelief, everything changes. That candle did exactly that. For the first time in a long time, silver forced the world to confront the question, what if this price level is not insane? And once that question is asked, it can't be unasked. The market didn't collapse afterward because collapse requires consensus. Instead, what followed was argument, confusion, debate. That's healthy. That's transition. True tops feel obvious in hindsight because they feel comfortable in real time. This didn't feel comfortable. It felt violent, unfair, confusing. That's because we're not at the end. We're at the point where the asset is escaping its old narrative. And here's the final data-driven reality check. Global debt is higher than ever. Real yields remain fragile. Energy systems are silver-intensive. And monetary trust is deteriorating, not improving. Nothing that caused silver to run has been resolved. The candle didn't erase shortages. It didn't rebuild inventories. It didn't restore faith in fiat systems. All it did was prove that when pressure is applied, price reacts instantly and explosively. That's not weakness, that's sensitivity. And sensitivity is exactly what you see before repricing accelerates. The market just told you it is no longer numb. It feels everything now, and markets that feel everything don't drift sideways forever. They move hard, fast, and often in ways that leave most people behind. The shooting star wasn't a gravestone. It was a flare shot into the sky saying, "This asset has entered a new phase." Whether you listen or not is up to you, but history is very clear about what happens next.